is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients are start yelling, "Swing, you bum," from the stands, and that's very tough for people to do.
If you have a passion for investing like I do, then you have probably heard Warren Buffett explain his core investing principles in the many interviews held over the years. But this particular 1985 interview goes beyond Warren Buffett's key investing principles and explores some of the finer points that are necessary to be a good investor. So today I have watched and rewatched this interview and selected some of the most important segments out of this interview. So sit back and relax, and if you do get some value out of today's video, I would very much appreciate it if you could take the 2 seconds to go below this video and leave a like on the video. These videos take a long time to put together. I tend to go through a number of different interviews and meetings to find clips that I think would be really, really valuable. So I would very much appreciate it if you could hit that like button. And hey, if you get a ton of value out of today's video, then make sure you hit that subscribe button so that you stay up to date when I post new content in the future. But with that said, let's jump into the first clip.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. Yeah. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But
in this first clip, Warren Buffett talks about and argues that the vast majority of money managers fail to outperform the market because they're focusing on the wrong thing. And what he says money managers are focusing on is the price movements of a stock over the next 12 months. Money managers even today use things such as technical analysis to see where a stock has been trending in the past and where it's likely to trend over the next few months. And in terms of fundamental analysis, looking at the underlying business, usually it ends at looking at future expectations for the next quarter or a short-term event that may be able to send the stock's price up over the next quarter or over the next year. There is rarely a focus on the underlying business and its performance over multi-years, rather than just focusing on what may push the stock price up emotionally when a short-term event happens or when their earnings are better than expected. And Warren Buffett's approach is pretty much the complete opposite.
Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
Buffett here says that he would actually prefer to not even know the price of the stock before he has tried to value it. And the reason why he doesn't want to know the price of the stock is because it is a psychological trait or a psychological bias to let the stock's price influence your decision in an irrational way, in an illogical way. A lot of people will look at the stock chart of a business over the past year or over the past few months and falsely expect that past performance of that stock price is equal to where that stock will trend in the near term. But how can you actually go about valuing a business before you've looked at its price? Because if you are researching a company to invest in, it's very likely that either on purpose or accidentally, you may have looked at its stock price. And I've actually got a trick for you to make this really, really easy. What you want to do is value a stock as if you're buying the whole business. And that way, it doesn't matter if you accidentally see the stock price. The only thing you need to avoid is looking at the price for the entire business, which is the market capitalization. And the market capitalization usually isn't plastered as the first thing you will always see when you're researching a company. So it's a lot easier to avoid looking at that. And then you can just assess the business as if you're buying the whole thing. You look at whole company revenues and how that's trended over time and whole company profits, and just pretend that you have a ton of money and that you are buying the entire business. And then at the end, you can divide the buy price that you come up with for the whole business by the number of shares outstanding to reach a per share buy price. and in that way you will not be influenced by the share price before you have valued the company. The only limitation to this method is it only works with businesses where the number of shares outstanding is stable or declining over time. If you have a company where the number of shares outstanding is increasing over time, so in other words, the management team is constantly adding new shares and diluting the share base, in those cases, you cannot assess the business on a whole business basis, because on a per share basis, it could be getting diluted over time. So only do this with businesses where the shares outstanding is stable or declining over time.
How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process.
In this clip, Warren Buffett talks about avoiding stimulation and how that can actually help you in the investing world. A lot of people have it the other way around. They think they should be turning on CNBC every morning and reading a ton of articles about what is happening with the Fed and inflation and all of these different things that are going on Wall Street and in the financial markets and in the news, but it's actually the complete opposite. You want to avoid all of that, and you actually want to try and have as little noise as possible so that you can focus on what actually matters, which is understanding the underlying business and projecting the cash flows of that business so you can figure out what you're actually going to get back from that business over the long term. And there's a couple of ways that you can go about staying away from stimulation when it comes to investing. The first is you can invest in companies that don't change substantially over time. So that means finding industries where there isn't a rapid change happening and businesses dying and new ones coming in, and a lot of stuff that is going to change over the next couple of years. Look for industries where it's been more or less the same for the past few decades. And then within those industries, find the businesses that have proven themselves, businesses that have a multi-decade track record of consistently growing their profits over time. And on top of that, you can just invest in really high quality businesses, businesses that have a really strong management team with a great track record of making good investments within the business and being honest and truthful and transparent with the shareholders. And of course, businesses that have really, really good long-term prospects. So that might mean that they have the opportunity to expand internationally after they've done really well in one particular market. Or it could mean that they have the opportunity to sell new products or services or create new revenue streams from their existing customer base.
What is the intellectual process?
The intellectual process is defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value.
Warren Buffett goes on to say that investing is an intellectual exercise, and the foundation of that exercise is making sure you stick to businesses within your circle of competence, only investing in businesses that you deeply understand. And for the vast majority of people that want to invest but have no interest in finance specifically or analyzing businesses, that is going to be no businesses. So for the vast majority of people, you won't know how to analyze any type of business. And that's completely okay. It's okay if you don't understand how to value any companies. There are perfectly good investment vehicles available to you if you don't want to invest in individual businesses or you don't know how to invest in individual businesses. You can invest in things such as index funds, which give you broad diversification. But if you are interested in analyzing individual businesses, then maybe you can figure out one or two or a handful of industries that you do deeply understand and that you can analyze businesses in those areas and figure out what they're worth. And in those cases, you should stick to those areas. Even if there is some hot new industry that everyone is excited about and that there's a lot of growth in that industry, just stick to what you understand, because that is where you are least likely to make a terrible mistake.
You literally every day have thousands of the major American corporations offered you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum," from the stands, and that's very tough for people to do.
I think this last bit is probably my favorite out of the entire interview, where Warren Buffett says that he might not swing for a very long time, meaning he may not invest in a new company for a really long time. And he actually says he may not invest in a new company for up to 2 years. And for most people, that is terribly boring and is not the way that they want to go about investing. They just have no interest in having that level of patience when it comes to investing. I shake my head and get very, I kind of laugh every time I see a new video come out on YouTube that says 10 stocks I'm buying in March of 2021 or 5 stocks that I'm buying in April of 2021. And this person makes these videos every single month, and they're always new companies. So if they truly are buying all of these different companies, they are doing the complete opposite of what the greatest investor of all time did to achieve his level of wealth, which is to not try and buy new companies every single month, but be patient. Understand that really good investment opportunities in areas that you understand take a long time to come along. I don't make these 5 stocks I'm buying in March or this month or this year videos because I honestly can't. I have invested significantly into only 4 companies over the past 3 years. So I physically can't make these videos unless I was just lying to you and making up companies that I thought were good investments. But I've only invested significantly into 4 businesses over the past 3 years. And even though I've only invested into a couple, while a lot of people have invested into 50, 100 businesses over the past few years, all four of them have delivered significantly above average returns over that period. And for some people, that might be boring to only invest in 1 or less companies every single year. But for me, I do not find it boring to spend a lot of time diving into the numbers of a business and understanding it deeply, and then going ahead and putting 10 to 20% of my net worth into a single business. For me, that is really, really exciting, especially when you do it right and it delivers you significant long-term returns. So I hope you guys got some value out of today's interview and my commentary on that video. And as I said at the beginning, these videos take a long time to put together, so I would very much appreciate it if you could leave a like on the video if you got some value out of it. And of course, if you want to stay up to date with my future content, then make sure you hit that subscribe button. But with that said, hope you guys have a great day, and I'll see you in the next video.